Hey, capital gains is something that's super confusing, and that's what I want to talk to you a little bit about today. This is another episode of Money and Meeting. My name is Matt Landon. So here's the thing about capital gains. It is the difference between the cost basis of what you had and the gain inside of your investment. So when we talk about this, there's short-term capital gains, there's long-term capital gains, and it ties in with a couple different things on people's tax return. So what I want to do is give you a little bit more clarity of how it works. And then there might be a few different strategies on what you can do. But the place to start is understanding what this is. So before you sell any kind of meaningful positions in a brokerage account, I want you to talk to your advisor and your CPA, and I want you to model those trades against your full return. So this is including other income sources. And here's what I want to do. I'm going to show you a little bit of how we do it in our office, just so you can see. All right. When you go right here, hopefully this is popping up and everyone can see it. But this is something that I modeled out, and this is showing an individual. I gave them $50,000 of income. I also gave them some IRA distributions and some pensions and some Social Security. Some of it's taxable, some of it isn't taxable. And then I also gave them, in one version, short-term capital gains. And the other version, I gave them all long-term capital gains. Now, here's the thing. When you have short-term capital gains, what happens is when you run this tax report, it adds everything together. It looks at the income that you have from working. It looks at your income from Social Security. And when it all ties in, what happens is the total income is $208,000. Then there's deductions. Well, for a single person, it's going to be a smaller deduction than a married couple. And then you have your taxable income. So the total tax bill for this couple, or this individual rather, who realized $100,000 in short-term capital gains. That means they held this position for less than a year. Think about it. You buy Coca-Cola stock or Starbucks stock or whatever else, something you're drinking. I'm drinking out of a Yeti, but this is coffee. So let's go with Starbucks. If you buy Starbucks stock, and this isn't in an IRA, this is in a taxable account, this is an individual account, a joint account, a trust, and you hold it for a month and then you sell it, you're going to realize short-term capital gains. You've got your marginal tax brackets. Notice how this shows up as ordinary income. Well, what if we did long-term capital gains? What if you held it for a year and a half and then sold it? Well, in this version, the only difference is, notice I copied everything over. The only difference is long-term capital gains versus short-term capital gains. Now remember, short-term capital gains, the total tax bill was all the way up here federally at $38,000. Just by triggering long-term capital gains, notice how it's $29,900. That is a huge difference. We're talking about a difference of almost $9,000, which is significant. Because what happens here is, notice how your marginal tax brackets, it stays in the 22. Why? Because that long-term capital gains has a different rate. It's being taxed at the 15% rate, as opposed to your marginal rate. Your short-term taxes are going to be taxed at your income tax rate. Now, if you're in a situation where your income taxes are really low, let's say we're saying in that 10 and maybe butting into the 12 just a little bit, notice where you can be with those capital gains. You can pay an effective rate of 0. This is something that I think is really, really key, and a lot of people miss sight of. So when you look at your capital gains inside of your account, when you think about realizing some of these positions, we're in a situation right now where taxes have been really, really effective, right? We've had a low effective tax rate. But beyond that, we're in a situation where the stock market has had significant gains over the last couple of years. So you might be in a situation where you have all of these capital gains. You see what's going on with the war. You see what's going on with the market. You're getting concerned. You're saying, let me just close out positions. I would encourage you, pay attention to those capital gains rates. Understand, how is this affecting my other sources of income, and how does it all tie in together? That's a tool that we like to use to model it out and get a good idea of what is your total tax burden going to be when you do this. The same thing holds true because you've got capital gains not just inside of tax accounts, you also have capital gains inside of property. So if it's your primary residence, let's say you've lived there for a number of years, you can sell that position and you don't have as much capital gains affecting you because you have an exclusion amount. That amount changes if you're married versus you're single, if it's been your primary residence for more than 2 years. But if you bounce between different houses over the time you've owned it, there's a formula. My point here is to say, don't just look at this one short video and assume that's going to solve all of your problems. But I would say when you look at your capital gains, look at it holistically. Think about, if I have a vacation home and it's appreciating much more rapidly than my primary residence. Yeah, you might have a house at the beach and you say, "Hey, I'm here. This house at the beach is going to double in value in the next 5 years." That's not necessarily the case for my other home. Well, where do you have as your primary residence? If you're spending a lot of time at that beach house and it could be your primary residence, you might be better off having that be your primary residence, because you're going to be able to write off more of those capital gains because it's growing or appreciating assets at a higher rate. This is why I think it's important to do tax planning. That is different than tax preparation. Tax preparation is sitting down with your CFP or CPA rather, and you're going through and you're filling out all the forms and you're filing your taxes. Tax planning is looking at things strategically and saying where we're at right now, where are we trying to go, and all of our different investments, all of our different asset classes, are they pulling in the same direction? Another thing you could look at would be Roth conversions. Am I better served realizing some of these capital gains or doing these Roth conversions? Or can I do kind of a combination of the two? But the long and short of it is, and I hope that I'm not making this too confusing, but the long and short of it is just this: when it comes to looking at capital gains, you need to understand, what does the decision actually cost, not just what does it look like on the surface. When you understand how those capital gains interact with the rest of your financial plan, you stop guessing. You're able to start making decisions with clarity in mind, as opposed to kind of a guesswork and a hope and a prayer when it comes to tax time next year. So I hope this has been beneficial. Thanks for listening. Have a beautiful day.